Let's go ahead and get started. So today is Wednesday, September 21st. This section is being recorded for being posted online. What we're going to do today is introduce some of the concepts that we're going to be required to do homework for. I'm going to give you some time today to work on homework for, just because on Monday your first group presentations are going to be given on during class hours by all of the teams. So let's go ahead and start there. So on Monday, as I said, the entire class will just be the 6 presentations on Dentsu. Each team will be presenting. I'll sit kind of over there, and you guys will be up here at the podium. You'll use the class computer to present. So make sure you either bring your PowerPoint on a thumb drive, have it available online. Most people use Google Docs. But nonetheless, you'll do the presentations on Monday. All of you will be presenting essentially the similar material. I'll have a stopwatch countdown timer of 10 minutes. As soon as you start, I'll start the timer. 10 minutes, you're done. Mid-sentence, I'll cut you off. Okay, so you have to be done in 10 minutes out of fairness to the groups. All right, so you can't go over time. And if you don't cover the material in that 10 minutes, you don't get credit for it, regardless of what is in your PowerPoint presentation. All right, you're also going to turn in a PowerPoint presentation by 8 a.m. on Monday, covering everything you're going to go through during the presentation. Okay, and so again, if it's not in the presentation, you don't get credit for it. All right, so make sure that you turn in that PowerPoint presentation by 8 a.m. And again, the minimum that you need to turn in the PowerPoint presentation, make sure you put your team name on it and all the team members, just to kind of validate participation. There will be a peer review that you'll have to complete next week as well, showing that everybody equally participated in that group project presentation. Again, if they don't, they can get zeros, and they go through as the team a grade. So if you don't know who your teams are by now, you really should try and meet them. You're all here today. You know, go shake a few hands, do whatever you got to do. But in any event, in terms of what's going to be required, like I said, at a minimum, for Dentsu, you're going to need some screenshots. A couple screenshots you're going to need is RV markets beta for the industry with a market cap weighted average. You're going to need it for each one of those segments that they're in. You're also going to need the same for the RV spreads, custom spreads, which we're going to talk more about today. And you're going to basically do those, so you got at least 6 screenshots that I can think of. And that's what you're going to be presenting on those segments. So make sure you cover the E, kind of like for each kind of summary of each of the segments, why they are more or less economically sensitive, why Dentsu is more or less economically sensitive relative to the industry, and a couple of drivers of that economic sensitivity or lack thereof for the industry. Make sure that you're talking about the industry spread and explaining it with today's 5 forces and how the 5 forces might change over time, specifically 5 years from now. And the 5 forces imply whether the spreads are going to get better or worse. Again, you're doing the industry analysis there. And then for the C, competitive advantage, you're going to talk about whether Dentsu has or does not have competitive advantage today and whether that's going to change over time. And that's the relative spread of Dentsu compared to the competition, again, in each one of those segments. It's a lot to cover in 10 minutes. Make sure you use numbers. If you don't use numbers, you're going to start seeing your grade go down precipitously. Okay, so generalized statements don't help you. You can't just say, you know, this is an attractive industry. You know, this industry is growing very fast. Those are just general statements. Okay, again, you guys kind of getting the deal for how I'm going to be grading in this class. So hopefully everybody will score very well, very clear on what we're going to be doing in the presentation. As I said, if you need to use notes, that's okay. In terms of the presentation, I don't grade based on you being all dressed up. So you guys can come just as you're dressed now. Business casual is fine, or actually student casual is probably a better word for it. And again, but you do have to cover all the material. You can decide who's presenting on behalf of your team. Again, if you have 7 or 8 members, you can't realistically do that in 10 minutes. So figure out who's going to present. Make sure, and again, where these presentations go awry is really 2 things. One, you don't practice, and then you kind of run out of time. or 2, you do some dividing and conquering, and then you don't sync up. So just make sure over the next few days that you do both of those. All right, hopefully fairly straightforward otherwise. Questions about the EIC presentation? Yes, sir.
So we're doing the C correct because that was in the
I'm sorry, what?
We're doing the C right because in the assignment the C wasn't there.
Oh, I'll have to make an edit then. Yes, you're doing a C. E, an I, and a C. Just like the last 2 homeworks. Okay. Any other questions? All right. So the other thing I just want to check in on is our Bloomberg Trading Challenge. Hopefully everybody's now off and participating in that. So if I go to Bloomberg, I'm going to just run through all of the sections since I'm recording this on video, starting with section 101. So again, I will score it based on portfolio value, which is where we are. I don't count. I just only made 1 trade. I'd be disqualified anyways. But regardless, this would be the order today. Remember, by the end of the first half of the semester, you need to be at least 10 longs. Okay, that's where we count. Doesn't matter how many shorts you have. And again, we score in relative portfolio value. In this section, it looks like only 1 team is actually has a positive return. Again, still tough markets out there. And everybody's meeting the minimum cash requirement of no more than $300,000. 201, what do you guys, 201 or 301? 201? Okay. Okay, let's go to portfolio value. Again, here, 1 team is barely squeaking by with a positive profit. Actually, okay, where's this team? N Wood. Are you in the room? N Wood. First and only warning. That is it. Next time I see $300,000 or more, you're disqualified. You'll get a 0 on the project, all of your team members, which will also not let them opt out of the final exam. So first and only warning. 300,000 is a hard rule. It's kind of like the hard deck in Top Gun. It's for your own safety. So other than they're going to be disqualified tomorrow if they don't buy something, these would be the current rankings. All right, section 301. Everyone has got other 300,000 available cash, which is good. Again, that's everybody's trading, which is good. And section 401, based on portfolio value. Good. Everybody seems to be following the rules of available cash generally. And that's all its teams are now trading. Again, need 10 trades over each half of the semester. All right, questions about BMC? For those of you working on it? Again, tips and tricks on BMC. What a lot of people forget, even though you're finance majors, so I'm just going to state it really, really clearly. There's 2 ways that we measure performance of companies. Okay? We're going to be doing both this semester. One is what I like to call absolute performance. Okay? Absolutely, you have to generate a positive NPV. Absolutely, you have to generate IRR greater than your R or your hurdle rate. Okay? Translation, you have to earn a good return on invested capital, all right, and a positive spread over time. You have to generate free cash flow. All right? You have to generate the revenue that supports that free cash flow. If you don't do that, you can't create value, and that's how we're going to eventually score companies. However, in the short term, okay, companies are worth the cash flow they will eventually generate, okay, and creating value is about exceeding expectations. All right, so in the short term, we also score based on relative performance, which is another way of saying, did you do what you said you're going to do? Okay, so in the short term, value is about exceeding expectations. Anytime there is an expectation or a forecast, it's not, is that forecast going to create value for that one period? It's, did they meet the expectation? Okay, so again, if I take Microsoft as an example here, you guys all have your terminals, and I go to EEO, then what we know is the sell-side analysts are forecasting Microsoft's financials, which lead to a forecasted cash flow. And given a hurdle rate, give you a forecast DCF. Okay. As a matter of fact, if you go to MODLs, these are the actual models that are being uploaded to Bloomberg by the sell-siders on Microsoft. Okay, right over here. Now again, we don't have authorization to download them. Wall Street charges for this research. Sell-side analysts charge basically $4 billion of research to the buy side per year. That's how they make money. Okay, so those buy-side hold opinions are not for you and me. Okay, they're for the buy side, but nonetheless, you can access this technically through Bloomberg if you have rights. But the idea is Bloomberg is aggregating all of these forecasts, and this is what they're forecasting, multiple periods. But notice that if you click on Launch Calculator, Bloomberg will basically give you a DCF model based on those forecasts, which gives you an intrinsic value, which is the share price of the companies. Okay, and so essentially, it's saying it a different way, all these models are aggregated to the EEO, which is the consensus estimate. So back to this screen. So given these forecasts of cash flows at a terminal value, that's worth 242 today. Okay, so the point is, anytime new information comes out, then the cash flows go up or down, then the value of the company goes up or down. Okay, and so when we're trying to forecast those future numbers, the other thing we're going to do is we're going to keep score. So for example, what we're going to do, and I'll switch this to one period back. If I look at 2000, Microsoft 2022 actual versus 2022 estimate, this is what the market had forecasted for 2022 for Microsoft, this column. This column is what Microsoft actually did. When Microsoft reports its earnings, 10Qs or 10Ks, and the earnings reports, this is what we check against. Did Microsoft meet the revenue target? Did Microsoft meet the earnings target? Did Microsoft meet the cash flow target? Okay. If we're accurate with the forecast, two things generally happen. Number one, it gives you a lower cost of capital because you're going to have a lower beta because basically you're more predictable. Okay, and that tends to help valuations. We value predictability. The other thing is if you start doing what you say you're going to do, or at least what you expect you to do, then there's more credibility in my future forecast. Right? And so for better or for worse, that's the point. Like you always wonder, like, why the quarterly earnings so important? It's not just about the quarter. It's we use the quarter to help us believe 3 years out, 5 years out. The simple idea, and it's not fair, but if a company misses a quarter, how can I believe that they're going to hit what they say they're going to do in 3 years? How can I believe what they're going to do in 5 years? They can't do what they're going to say they're going to do in 3 months. Okay, that's risk. So said a different way, that's why we keep score. Right? And the way we're going to keep score is relative performance. Did you do what you said you're going to do? And if you're off, that's risk. And then there's going to be trading based on that. Okay, in either direction. Right? So every time there's an earnings release, there's usually activity in a stock. Anytime there's new information that will cause us to adjust these forecasts, that's going to cause the stock to go up or down. And so again, it's not just about making or losing money. I could be losing money and lose less than expected. That will drive stocks. Matter of fact, that's what happened last week with inflation. Inflation actually went down, okay, last month it was CPI. Inflation actually went down when they reported it, right? But the problem was it didn't go down as much as expected. That's why the market collapsed, right? So again, it had nothing to do with high inflation. If the market had actually met the forecast for inflation, you would have seen a stock rally. All right, because again, everything is based in the short term on expectation, which is a long-winded way of saying if I'm doing the Bloomberg Trading Challenge, that's how you win. Like you want to find the missed expectation. What Warren Buffett calls it the broken stock, right? Basically where the market's getting it wrong. Right? Now, unless you're Charlie Sheen in Wall Street getting insider trading, you got to do your homework. And there is a little bit of guessing in this because you're not insiders. But even insiders don't have a full view of the future. But that's the point. You're going to win the trading competition if you can find the broken stock, right? Where companies either exceed or miss expectation. That's where their stocks are going to move. That's where you can trade, right? So I'm just giving you another idea that that's the other advantage of the tool. You got a lot of news sources. You got a lot of analyst reports talking about this. You got to know what the expectations are. You know, you can actually make some decisions and judgments based on that. So in the short term, it's not about intrinsic value. Okay, and that's the difference with the trading competition. And you might say, gee, that seems a little unfair because if we're trying to predict the future and the future is uncertain, how can I be graded on that? Well, number one, that's the real world. But number two, it forces you to pay attention to the news. Because if you're not paying attention to the news, you're going to really struggle with the trading competition unless you were like my sister when really young. We went to the horse races and she picked a jockey to win because she liked the color of their jersey. Okay, now you might get lucky. That doesn't mean you're good. Right? So back to the trading competition, that's what your team should be talking about. That's what you should be looking at, is the missed expectation, the changed expectation, the underestimated expectation. That's where stocks are going to move in the long run, in the short term. All right. Questions, comments about any of that? So the next section of the class that we're going to get into is what differentiates this class from just about every other class you will take in any other school when it comes to enterprise valuation on DCF. Because McKinsey's approach is different than the approach of most banks and almost every other finance program out there. Okay, and it's not taught in many schools, right? But the valuation book includes McKinsey's approach. And the point is, what we're going to do, and you're going to hate this, but starting after next week, we're going to be going to the second section. It's called historical analysis, but we're going to be rearranging financial statements, accounting statements, into an economic format based on Modigliani-Miller. And it's an extra step that a lot of other people skip when they do valuations. They go straight from accounting statements to cash flow statements. And McKinsey puts this extra step in there that basically says we're going to take the accounting statements, make them economic statements, forecast the economic statements, and that's going to give us our valuations. There's two reasons why they do that. Number one, it's more work up front, but when you do it, it actually gives you cleaner valuation, understanding what's going on with the business. And number two, because it's a cleaner and more straightforward evaluation, then you actually get better valuations of the companies because you get a true understanding of where the companies are creating or destroying value. So more on the readings, just reading the book, because your midterm exam, which is coming up as well, is going to be on converting the statements. Okay, and a couple assignments are coming up. So I'll give you income statements, balance sheets. You're going to put them into the McKinsey format. It's like learning a new language. Initially, it will be difficult, but once you do it, you're going to like it because it will definitely help you get better understanding, a leg up on the valuations and analysis that we will do. Okay, so I'm just kind of warning you about that. But as a preview to that, I just want to talk about the major reason why McKinsey does this. And I'll use this slide from the upcoming lecture notes on what we're going to be talking about. And it's relevant to your homework assignment for today, okay, and your presentation next week. So basically, there's two views of return on invested capital / cash flow, right? And what's important about McKinsey's approach, which is the one we're teaching, is that ROIC is free cash flow. Okay, it's just a shortcut, right? They're actually mathematically equivalent, and I showed you that in the video that you should have watched last week. Okay, but that's the point. Like ROIC is free cash flow, and so it's hard to forecast free cash flow. It's easier to forecast ROIC, and so McKinsey forecasts ROIC, right? Whereas, because you go to a company and you start talking to them about free cash flow, and they're like my chihuahua, like his name is Monk, and Monk like looks at me and talks to me and he's happy to see me, but I know when I talk back to him, there's no comprehension, right? And that's the problem with a lot of people with free cash flow. Like it's hard to figure out. Like it's just not a statement that we prepare. We got to do a lot of work on it, which you're going to do to basically create it. It's much easier to do that with ROIC, and they're going to be equivalent over the long term. So that's the whole point. McKinsey is an ROIC-based valuation company. It's a proxy for free cash flow, makes the ROICs and free cash flows easier to understand. So one of the things we talk about is Modigliani-Miller. And the whole point of Modigliani-Miller is what it says, and here's a picture of the graphic here, is that enterprise value, what's known as EV, is a function of two things. It's the value of the company's cash flows, okay? But they're broken into two components, or boxes. One is called operating cash flows, and the other is called non-operating cash flows. All right, and they basically are what they sound like, meaning operating cash flows are the cash flows that come from operations. It's selling our products and services, doing what we do as a business, as a normal course of business. Okay, we have sales, we have cost of making our product or service, we hopefully have a profit, we're investing to do that, the assets to do that, that's an operating cash flow. Okay, but companies also do other things or own other things that have nothing to do with their operations. Okay, I might own a bunch of land somewhere. Okay, I just bought a bunch of land. Okay, I don't have a plan on it. I don't do anything with it. I just own it. Okay, well, that has nothing to do with a business cranking out sales of their products and services. So what I'll do is I'll say, okay, I'm going to value that separately, the non-operating cash flows, and I'm going to add the two together to get the overall value of the firm. As a matter of fact, that's the approach to valuation, which is we value the operations, the operating cash flows. We value the non-operating cash flows. We add them together in present value form, and that's called enterprise value, very simplistically. Okay, so the key here is identifying, when we look through the income statement and look through the balance sheet, what's operating and what's not. Okay, and the question that we're eventually going to address is basically, for operating, is does what we're doing help us deliver the product or service directly, right? And if it does, it's probably operating, okay? So for example, if I'm building inventory, that's going to be sold to a customer, that's operating, okay? If I put together a manufacturing plant that I'm making that inventory in, that's considered operating, okay? If I'm hiring people in the plant to make that product, it's probably operating. If I'm shipping the product to a customer, it's probably operating. Because if I don't do it, they can't buy my product. Okay? So those are just pretty obvious things. But some of the things we're going to do is non-operating. And the biggest non-operating asset is I got a bunch of cash sitting in the bank that I've made that I haven't paid out and distributed to investors. Well, that's non-operating. I don't need a bunch of cash in the bank to make more products, right? So it has value, but it's going to be valued separately, okay? And again, just to give you an illustration of this, the tech companies have a lot of this. In fact, Microsoft, or the big one that we like to talk about is Apple. If you go to Apple US Equity, and we go to FA, which is the historical financial analysis for Apple, this is Bloomberg's calculation of enterprise value. But you'll notice here on this page that Apple, as of September 2021, which was last year, okay, because they'll report their September results coming up in a few weeks for 2022. Their fiscal year ends in September. They had $190 billion worth of cash on their balance sheet. Okay, so the point about Apple is Apple doesn't need $190 billion worth of cash to sell you the next iPhone. Okay, so said a different way, if Apple had $365 billion worth of sales last year, okay, and sold another $365 billion worth of stuff, would it have to borrow another $190 billion above and beyond to just put more cash in the bank to sell that many iPhones? And that doesn't make any sense. So that's the point of a non-operating asset. Like, a non-operating asset has value, it's just cash sitting in the bank, but I don't use that cash to sell more iPhones, okay? So that's just extra excess cash that's sitting around. So when I value Apple, you can think of Apple as two components. Apple is a business that sells Macs and iPhones and increasingly services, plus $190 billion worth of cash. You put the two together and you got Apple. Okay, does that make sense to everybody, kind of conceptually? So what matters here is when we look at Apple, we got to do two things. We have to say, on the income statement, revenue and costs, what's operating and what's non-operating. Okay. In fact, there's a third thing, what's debt. Right? And then we're going to look at the balance sheet, we're going to do the same thing. What's operating? What are the assets on the balance sheet are they actually using to make their products and services? Assets and liabilities. What's operating? What's non-operating? Okay? So conceptually, go back to our little PowerPoint here. two views of ROIC. The one on the left is the traditional view, okay? It's the one taught in every other business school. It's the one used in Wall Street. It's the one that Bloomberg actually uses to calculate ROIC when you've done your assignments so far this semester. It's the default methodology, right? And what I always like to say is, I'm old. I went to Wharton in the 80s, and that's when the formulas were first written. You know, all modern corporate finance can be traced to the University of Chicago in the 1970s. They trained a bunch of PhDs, which went to the top schools, right? My finance professor at Wharton came from Chicago, okay? The textbook we used was written at Chicago, okay? Those were the things that have permeated finance for the last 50 years. The formulas that we use today were created in the 70s and 80s. And I like to joke that it was a simpler time. So when they calculated ROIC initially, and this formula's not really changed in 50 years, they basically said, we're going to do two things. We're going to take the profit from the business, EBIT, okay? Now, the one thing that hasn't changed is we're going to separate out the idea of financing from operations, okay? Because if you have two businesses that are equally profitable, one has debt and one has no debt, the one with debt is going to make less money, okay? The two businesses are identical in every way, but just one has debt, the other has no debt. The business with debt is going to make less profit, okay? That's a financing choice. So one of the things they originally did is they said, we're going to take the financing choice out of the business and say, how profitable, how valuable is the business, regardless of financing, then we'll apply the financing. That's the whole point of a WACC. The WACC is applying the financing, okay? Take out the financing, you're left with the operating profit of the business, known as EBIT for short, earnings before interest and tax. Now, technically, EBIT isn't always operating profit, because you could stick a few things into EBIT that are non-operating, but for the most part, EBIT is a proxy for operating profit. It's profits you're making running your business day to day. And then we had to pay taxes on it before we get the money. So EBIT after tax, better known as NOPLAT, or the rest of the world calls it NOPAT, okay? So that's your profit. Now, if we're doing return on investment / return on invested capital, that's the P, then what's the I? What's the investment? The investment comes from the balance sheet. Balance sheet has to balance, we have assets. The only difference is accountants break out liabilities into current and long-term. What finance people do is we rearrange the liabilities, not current and long-term, we rearrange them to nibbles and nibbles. Non-interest-bearing liabilities, interest-bearing liabilities, okay? So non-interest-bearing liabilities are basically saying that when I owe you money and I pay you back later, the amount I owe you does not change. That's called a non-interest-bearing liability. For example, accounts payable, right? So if I owe a vendor some money that I'm going to pay them in 30 days, whether I pay them on day 1 or day 30, the amount I owe them does not change. That's called a non-interest-bearing liability, and accounts payable are typically the biggest one. IBLs, known as interest-bearing liabilities, if I pay you back in 30 days, I owe you more because I owe you interest on that, okay? So if the amount changes, the longer it takes me to pay you, that's called an interest-bearing liability. For example, debt, okay? Got a credit card, don't pay out the balance, they're gonna charge you interest, okay? That is an interest-bearing liability. So what we do with liabilities is we just say, let's rearrange the balance sheet, put the non-interest-bearing liabilities on one part and the interest-bearing liabilities on the other part. Okay, don't care about current and long-term, just interest-bearing, non-interest-bearing. Okay, the third part of the financing is called equity. I owe shareholders a return. Implicitly, that's an IBL. Okay, because shareholders, when they give you money, want something back. All right, the difference between an interest-bearing liability and a shareholder is that the interest-bearing liability is defined, meaning banks tell you, pay me back this amount. Shareholders, if you ask them what they want, they just want more. But they still want something back. So in a sense, you've got to give a shareholder return. So when we look at the financing of a business that requires a return, if you look at this chart here, that is the interest-bearing liabilities plus the equity. You add those two together, that is the financing given to a business that requires a return. Now, because a balance sheet has a balance, that equals the rest of the balance sheet, which means it equals all of the assets minus the non-interest-bearing liabilities. That's called invested capital. Okay, so invested capital means two ways to get to it. They're equal because a balance sheet's got a balance. One way is tell me how much you spent. That's your assets. Minus any free financing, that's the total amount I have invested in the business that I had to finance. Equals the debt and equity given to the business. And the two are equal. So if I have, think about buying a house. If I buy a $500,000 house, I have $500,000 worth of financing. If I buy a $600,000 house, I have $600,000 financing. If I buy a $200,000 house, I have $200,000 worth of financing. More house, more financing. Same thing with companies. More assets, more liabilities and equity. Okay, because that's equal. So that's the whole point. I can look at invested capital two ways. I can look at the house, the assets minus the non-interest-bearing liabilities, or I can look at the financing, the debt and equity. They have to be equal. So very simplistically, what is return on invested capital? It's the return on the financing. How much money did I give you that requires a return? What's the profit on that? ROIC. Equals, how much did you put into the business? What's the profit on that? ROIC. Two ways to look at ROIC. That's the actual definition Bloomberg uses for return on invested capital. It's return on invested, it's return on the debt and equity. Okay? With one exception. They use what they call net debt, which is interest-bearing debt minus cash. So return on invested capital in Bloomberg and most textbooks is profit, no plat, EBIT after tax, divided by debt minus cash plus equity. That's the net financing. Because the theoretical idea is if I got a bunch of cash, I can use it to pay out the banks. Okay? I chose not to, but if I really wanted to, I could pay out the banks, and then what I'd really owe is after the cash is paid off, what's left. So net debt plus equity. That's the definition in Bloomberg. That's the definition in all the textbooks that you've taught, even here at Maryland, up until this class. But the problem with that definition is all the assets equal that. Some of those assets are operating. Some of those assets are non-operating, and ROIC traditionally does not distinguish. It just says, I give you money, you put it to work, I don't care what you do with it, just give it back to me. That's kind of the implicit definition of ROIC. Over here on the right is McKinsey's view. And McKinsey says, yes, that's true. The return on the average asset of a company is part of the Bloomberg ROIC. But those assets can either be operating or non-operating. So what we're going to do is we're going to say, what's the return on investment for the operating assets? And what's the return on investment for the non-operating assets? The average of the two is the return on invested capital for the company. Okay? So Bloomberg and the rest of the world uses the average. McKinsey breaks down as two component parts. Here's the reason. How much profit do you think Apple's making on $190 billion worth of cash that's sitting at banks? What rate of return on investment do you think they're making on that cash? Yeah.
0.5%.
Yeah, some meager amount. Okay, interest rates have been skyrocketing recently, so it's now probably like 2%. But regardless, they're making some cash return on it, but they're not making 50%. Whereas, and that's the point. If we go to our RV custom spread template, and we look at Apple's ROIC over the latest filing, which is the last 12 months, what you're going to see is that their ROIC is 55%. Okay? So if they're making generously 2% on $190 billion worth of cash, how do they make 55% as a company? Well, clearly, selling iPhones and Macs and iPads and watches and other stuff makes a whole lot more than 2%. That's the operating return on investment. The average of the two works out to be 55. So everybody understand that conceptually? So what is the return on the iPhones and the others? That is something called operating ROIC. I suppose non-operating ROIC. So I'm going to add to this list the operating ROIC. And what I see is that last year, Apple's operating ROIC was 456%. That means if I put $1 towards selling an iPhone, I made $4.56 of profit for every dollar of investment. Is that pretty good? All right, so here's the point. This is how people misvalue a company. I'm going to add a column called ROIC, and just to get my periods correct, technically that operating ROIC is on last year as opposed to latest filing, so I'm going to switch this to latest year. So last year, Apple averaged 46% ROIC. Okay? Now how do you get 46%? When they sell an iPhone, they make 456%. When they put cash in the bank, $190 billion of cash, they make 2%. You do the average of the two, you get 46. Okay? But if Apple sells more iPhones this year, what return does the iPhone make? Does the iPhone, the next sale, make 46%? Or does the next iPhone make 456? I spent $1,500 on an iPhone last week. Are they making 46% of that, or are they making 456% of that? They're making 456%. So that's the point. If I'm forecasting Apple and I'm forecasting their sales, and I forecast more sales of iPhones, and I'm forecasting Apple's sales of iPhones to make 46%, as good as that sounds, I will undervalue Apple. Does everybody see that? That's the problem with traditional ROIC. That's what McKinsey noticed. Because when you're using an average, you're basically saying you're going to make the average going forward, and then you're going to forecast that average. But the problem is that average includes $190 billion of cash, making a meager amount of return. And that is not what Apple's going to have to borrow again to sell the next iPhone. That's actually why Apple is more valuable. A lot of people fail to understand, because they're making so much money and they really do it with so little investment. Yes, sir.
Which system, the analysts on this platform, do they use the McKinsey one?
Well, the point is, everybody in Bloomberg uses Bloomberg ROIC because it's the standard, and they use the average. However, what you'll notice when you read through the analyst reports, go to BRC, pick any JP Morgan analyst reports, which we have access to through our license, and you'll see free cash flow. And what they'll do is they'll forecast free cash flow, which is based on reorganizing the Bloomberg ROIC to the basically the McKinsey version, which is really just a proxy for free cash flow. So they'll still forecast the free cash flow. They just don't do what McKinsey does in rearranging their ROIC. Now, here's part of the reason why. Again, back in the 80s, when I was in your shoes as a student, okay, long, long ago, I like to joke that the world was a simpler place. Like, we just didn't have a lot of non-operating assets. We didn't have global joint ventures. We didn't have companies that had $190 billion of cash that weren't banks, right? As a matter of fact, Apple is a bank. They have a credit card with Goldman Sachs. Like, all that stuff is new in the last 50 years in corporate finance. So when the formulas were originally designed, there really weren't a lot of non-operating assets. Right? There really weren't a lot of global joint ventures. Intellectual property was not substantial in companies' valuations. And so it was just simple. As a matter of fact, the only real non-operating asset they had was cash. In fact, that was the whole point of net debt. It was operating asset minus non-operating. Cash was the non-operating. It was the only one we really had to deal with for most companies. And most companies didn't have huge cash balances on their balance sheet. So the difference between these two ROICs, historically, operating ROIC and average ROIC, was actually fairly minimal. Okay? And it's only for some companies that it's substantial. So if there's not much of a difference, it's not going to matter to the valuation. If there is a difference, it is going to matter for the valuation. And I'll give you another example. So if I save this, and I replace Apple with Costco, as an example, Costco, what you'll see is that Costco's operating ROIC and Costco's Bloomberg ROIC, or what people just call ROIC, it's not that different. It's a little different, but it's not like Apple. It's not extreme. Okay? So if I use Costco's proxy, I might still undervalue Costco a little bit, but I'm not going to miss by a barnyard. Like, if I'm going to Apple, I'm like shooting the wrong direction, right? Because that's the point. That's what we're getting into. Does that conceptually make sense to everybody? All right. So operating ROIC, which just rearranges the assets to look at what's just operating, so we've got to identify what's operating, what's not, is important because it gives you a sense of what the real value of the operations are. Now let's translate this to EIC. So if I'm doing an EIC on a company like Apple, which number should I be using if I'm really trying to understand the tech industry? Should I be using the regular ROIC, which is the average? Or should I use the operating ROIC, which is just the operating performance of the businesses? If I'm doing an EIC, which one should be more important to me? Hint, hint, operating. Heretofore, we don't have operating ROIC in homework 2 or homework 3. You did it on Bloomberg ROIC because you didn't know any differently. And Bloomberg doesn't actually have operating ROIC in here because they haven't changed this formula that Wall Street uses in 50 years. They use the average. So how do we put that number that I have in here in your terminal? In order to do so, you have to create a custom formula. So I assume in your certification, you saw that you can create a custom formula in Bloomberg. There are 2 areas at which you can create a custom formula in your terminal. Doesn't matter which one you use, but these are the only 2 areas of the terminal you can create a custom formula. One happens to be right here on the RV screen. Okay? The second area you can create a custom formula is in the equity screening tool, EQS. So either EQS or RV are where you create custom formulas. When you get a Bloomberg account, you have no custom formulas in your account. When you create a custom formula, it is unique to your account. Okay, so it doesn't go to the whole Bloomberg system. They have their formulas, but it goes to your account as a custom formula that you could use. And so the other feature of custom formulas is you can use any field in Bloomberg as part of your custom formula, or you can use custom formulas you've previously created to build future custom formulas, kind of compounding them. Okay? That is homework 4. But here's the key to homework 4. You're going to calculate an operating ROIC using custom fields for Bloomberg, right? Technically, the assignment's due on Monday, but I'm going to give you some time in class today, okay? Because obviously, if you don't have access to the terminals, you can't create the custom formulas. Here's why it's also important. On Monday for your team presentations, the screenshots you're going to do for Dentsu must be operating ROIC. So one member of your team has to at least do this, because for the 3 screenshots you're going to do on Dentsu for their 3 segments, and you talk about spread, the spread is going to be based on operating ROIC. The spread is not going to be based on Bloomberg ROIC. We're switching. So if we had done Microsoft, and I just use the analyst curated BI as a proxy, then you would see that when you did your write-up for the industry and the industry attractiveness, Microsoft's operating ROIC was 53.7%. The industry operating ROIC was actually 40%, as opposed to 22% for the Bloomberg ROIC. So as attractive as the industry was, we actually underestimated how profitable this business really was, because companies like Apple and Google and Microsoft and Oracle have huge amounts of cash sitting on their balance sheet. And so it actually underestimates how well these industries are performing in tech because of that. So, and they do that mainly to avoid taxes, right? So long story short, we would have actually done a 40% industry ROIC against a 9.6% WACC, and we would have had 53.7% operating ROIC to explain for Microsoft against a 9.6 WACC. So similar trend, just even better performance when you explain the five forces. All right, questions about any of that? So you might say, gee, how do I create a custom formula? So let's go back to homework 4. So in order to create operating ROIC, you have to create a few other custom formulas. Bloomberg doesn't have McKinsey's definition of NOPLAT in it. Okay? It has a different way of calculating what they call NOPAT. So we've got to put it in there. So the formula for NOPLAT is operating income times 1 minus the tax rate. Okay? And you might say, gee, why is it divide by 100 on here? Because Bloomberg actually stores the tax rate as like 23. Okay, if it's 23%. And so if I want it to be 23%, I got to take 23 and divide by 100. So if you wonder like why you do that, because you remember you're dealing with a database, and the database has numbers stored in it, and we got to look at the format of the number stored, and then we either have to use that number, or if it's a formula, we might have to make an adjustment. So that's why I'm doing the divide by 100 in there. Make it 0.23 versus 23 if I'm trying to divide by 100 for tax rate purposes. Does that make sense? All right. So again, NOPLAT. So how do I create NOPLAT? So basically I come here, in RV, custom, over here, there's a gear icon. When you click on this gear icon, add formula. Okay? That's how you create a custom formula. Or in EQS, the equity screening tool, you can come in here to formula, click on formula, and that's the same thing. Add formula. Those are the only two places you can create the formulas in Bloomberg. Okay? Now, I'm going to go back to RV. So when you click on the gear icon and you click on the add formula, okay, first of all, it will give you a formula library. In your formula library, these will be all my custom formulas, my formulas. Right? So I've been using Bloomberg for a while, and I've created a lot of custom formulas. Okay? Yours will be blank if you click on my formulas. Okay? And by the way, you can also have Bloomberg formulas over here. Okay? But regardless, this is where your formulas will be stored. Now back to this. So go back to custom. Discard. Sorry. Custom. Add formula. All right. So here's the point. What is my formula? All right. One thing I can do is I can come up here where it says function or field, is I can actually choose an actual field to start with. So for example, here, it is latest fiscal year, operating income or loss. So I come to Bloomberg and I can start typing in here, operating income or loss. Now, as I start typing in it here, or I can click on fields and scroll through the list, basically here are the Bloomberg fields. Operating income or loss. Okay? So it's either used for screening, EQS, or a display field, report. Okay? So I'll click on that. and it'll say, which one do I want? Now, previously, when we did the ROIC, we did it based on the latest filing, okay? But when we do operating ROIC, we're going to do it based on the latest year, okay? So last year, last full year that they reported. So it's a reported year as opposed to a rolling 12 months. So that would be latest year, okay? And then you hit enter. Now down here, that's the actual Bloomberg database field. Okay, so you can either write these custom formulas by looking at the absolute database name, which you will not know, or you can type in the friendly name up here and it will start building your formula for you using the custom name. Okay, so that's operating income minus equals Y, which is the last reported year. Okay, now, then what I'm going to do is follow my formula. Is I'm going to multiply that by 1 minus the effective tax rate. So I'll put a parentheses here. Parentheses there. Times left parentheses 1 minus, come back up here, effective tax rate, latest year, enter, adds 1 minus the effective tax rate for the previous year, is the period. Okay, I'm going to take that tax rate, I'm going to divide by 100, because I know from history that if I put in tax rate, it's not a decimal, okay? And so I want a percentage, so I'm going to turn it into a 0.23 because it's going to store it in the database tax rate without the decimal, okay? So then, get my order of operations right, parentheses, do I have that right? I think I put a parenthesis around the whole thing. Make sure I get this right. There it is. All right, so there is my basically data, and then I can either save the formula or I can save and use an RV, which means it'll actually not just save it, but then it'll show up in my custom template. So I'll use save and use an RV, and I'll call this, what was the formula name that I use here? Just no plat. Now this is going to be dollars. No plat, just fall 22, because I already have no plat in there. There you go. And then save and use. Now, again, it's going to put this as a field in my system, but the point is, there, when I saved and use it, is my no plat fall 22 formula, and these are the dollars in no plat. Questions about what we just did or how I did it? Okay. So then, we'll come back here and we'll continue on. I need something called operating cash. So the point is, companies are going to need some level of cash to run the business day to day. Okay, that's what we're going to call operating cash. That cash can never be paid out. 2% of sales is the rule of thumb that we use. Basically, 1 week of cash. Right? 1/50 of the year is 2%. So 2% of sales is cash that you need to just run the business day to day, working capital. So as part of our working capital calculation, what's operating cash? That's not a formula in Bloomberg. We got to create it here. Operating cash, 2% of revenue. Last year's revenue. Okay. Next formula is operating working capital. Notice not accounting working capital, because accounting working capital is current assets minus current liabilities. That's not what we're using. We're using the things that are just operating. Okay, so typically, because Bloomberg has standardized statements, it's going to be the operating cash plus the receivables plus the inventory minus plus the other current assets, minus the payables and other short-term liabilities, all from the previous year. Yes, sir.
If I save and use an EQS, will it also be?
Yes.
Okay.
Any formula that you save will go in that formula library, and you can either use it in EQS or you can use it in FA, okay? Or sorry, RV. The one area, for some bizarre reason, you cannot use custom formulas in FA. I don't know why. So translation, they'll let you do it on benchmarking data, but they won't let you do it on one company's historical data. You can't do custom formulas there, okay? Now, you can do custom formulas if you export the data and put it in Excel, but it won't actually work directly with the system, okay? So again, you're working through these and then using operating cash in the operating working capital. Then you'll do operating invested capital, which is working capital plus PP&E plus goodwill. And then you'll calculate an ROIC, no flat divided by operating invested capital times 100. Okay, so that's going to get you the operating ROIC for last year. Make sure you use last year. Okay, now finally, once you do that, just as a test, I want you to go to the equity screen tool and use that operating ROIC as part of an equity screen. Okay, so back to EQS. You're going to do an equity screen. Okay, and so here is where your add criteria, which will include your custom criteria. So for example, operating ROIC, right there is my operating ROIC custom formula, which I created previously that I could use in the screen. Okay, so the screen that you're going to put together is for the S&P 500 index. So you're going to type in SPX for add criteria. And then that'll get you down to 500 companies, 503, because some of the dual listed stocks. Then you're going to put in operating ROIC greater than 20%. So Op ROIC, choose that condition greater than 20. That's going to lead to, there's 144 companies that last year had an operating ROIC greater than 20%. Then you're going to look for companies that have a revenue growth rate year over year greater than 15. So you can start typing in growth, estimated revenue growth year over year greater than, what did I say, 15? And you use the AND criteria, so that filters down to 40 companies that were growing faster than 20% that had an ROIC greater than 20. And then finally, I want companies that have a bull beta greater than 2. Is everybody familiar with the concept of bull beta or bear beta? Bull beta basically says, I'm going to calculate a beta against the S&P 500, but I'm going to ignore all the down days. I'm just going to look at the up days. So when the market goes up, what happens to the stock? I don't care when the market goes down what happens to the stock. I just want to know what happens when the market goes up. That's called a bull beta. The bear beta is the opposite. I ignore all the up days. I just look at down days. So when the market goes down, what happens to the stock? It's called a bear beta. So the idea is in a rising market, the high bull betas go up much faster in a rising market. So who do I really care about in the market going up? In fact, for your stock trading competition, you might start thinking about bear betas. Because if we're in a tough market time, who's going to go down much faster when the market goes down? That's a bear beta. Okay? As opposed to a beta, which is it doesn't care which way the market goes, just how does it react to the market in general. So I'll let you finish the criteria. You'll get down to a number of companies. When you get down to this number of companies, which will be less than the 40 something, your final thing we'll do is you'll click See Results. And however many companies are there when you put in the bull beta. And then basically, these companies will be your list. That's the screenshot you'll submit. Okay, now it's not this screenshot because I didn't have the bull beta criteria, but that's the screenshot you'll submit for homework. Okay, so you need to create your custom formula for operating ROIC, and then you got to use that formula in the custom screen to make sure you got it right. And then that's all you're submitting. except you got to go back and you got to do this for GD US equity. So go back to the screen that has RV, GD General Dynamics, US equity, and submit that. Actually, I'm going to change that. Take that back. Change the assignment right now. Real time, because I don't think anybody's actually done it yet. I'm going to change the screenshot to Microsoft. Okay. So that's the other way we'll test to make sure you got your formula right. So, two final things. One, this is due Monday, so technically you don't have to finish this today, but I would strongly recommend using the time in class time to do it. And two, for your team projects, you have to use Operating ROIC for your EICs, for your eyes. All right, questions about any of that? I'm going to give you the rest of class time to work on this. Just up front.